The 1970s were not just another decade of inflation and oil shocks. They marked a turning point, the decade when money itself changed its meaning. What began as a political and monetary adjustment ended as a global transformation that redefined the relationship between governments, markets, and people's savings. Before the 1970s, the global economy ran on a system built at the end of World War II, the Bretton Woods Agreement. Under it, countries pegged their currencies to the US dollar, and the dollar was convertible into gold at $35 an ounce. This structure was meant to provide stability and prevent the kind of economic chaos that had followed the Great Depression. But by the late 1960s, the system was breaking down. The United States was running large budget deficits due to the Vietnam War and social spending programs at home. As dollars flooded the world, foreign governments began to doubt America's ability to maintain the gold peg. They started demanding gold in exchange for dollars, and U.S. gold reserves began to fall sharply. In 1971, President Richard Nixon took a historic step. He closed the gold window, suspending the dollar's convertibility into gold. This single act effectively ended the Bretton Woods system and transformed the dollar into a fiat currency, money backed not by metal, but by government decree. At first, it was intended as a temporary measure. In reality, it was the birth of the modern monetary era. The consequences were immediate. Currencies began to float against one another, and their values fluctuated based on market forces rather than fixed exchange rates. For the first time, money became something whose value could change daily, a new and unsettling concept for many. At the same time, the world was hit with a new kind of economic shock. In 1973, the OPEC oil embargo caused oil prices to quadruple. This triggered a wave of inflation that rippled across the globe. The traditional tools of economic policy, like raising interest rates or cutting spending, seemed powerless. Economists called it stagflation, a rare combination of stagnant growth and high inflation that defied the logic of earlier economic theories. Central banks, particularly the U.S. Federal Reserve, struggled to adapt. The experience of the 1970s forced policymakers to rethink what money was and how it should be managed. The focus shifted from fixed exchange rates to controlling inflation expectations through monetary policy. Interest rates became the main tool, and central banks began to play a much larger role in guiding the economy. Meanwhile, the financial world evolved rapidly. As exchange rates floated, businesses needed ways to hedge against currency risks. This gave rise to new markets in derivatives, futures, and foreign exchange trading, laying the foundation for the global financial system we know today. The era of free-flowing capital had begun. By the end of the decade, another shift had taken hold, the idea that markets, not governments, should determine value. The inflation and instability of the 1970s discredited the post-war model of heavy state control over economies. This intellectual and political change paved the way for the neoliberal policies of the 1980s, deregulation, privatization, and the belief in market discipline as a stabilizing force. In short, the 1970s changed money in both form and philosophy. The dollar became fully fiat, the gold standard was gone, and inflation replaced stability as the main concern of economic management. Central banks gained independence, financial markets globalized, and money itself became more abstract, a symbol of confidence rather than a claim on metal. The decade's turmoil reshaped how nations viewed economic power. Monetary policy replaced gold reserves as the ultimate weapon of stability. And the lessons of that era, the fragility of fixed systems, the power of inflation, and the dominance of confidence, still define the way our financial world operates today. The 1970s didn't just change how money works. They changed what money is.